Things have fallen quite a bit. Maybe there's an opportunity here. But just because something fell in price doesn't make it a good investment. All right, guys, my list of 20 to 25 stocks that I want to own for the long run or for forever. Remember, big caveat. My analysis is my analysis. You need to analyze it yourself. In all likelihood, I will probably have a higher price than you. When Mo and I do these analyses, I have a higher price than Mo. Why? Because I'm willing to buy a stock and let it accumulate and grow, because my strategy is to own large companies at reasonable prices. Now, do I think I can get great prices on them? Absolutely. So, first stock, Sherwin Williams, based out of Cleveland, Ohio. Good old Sherwin Williams. They make paint, and we love them. So let's check them out here. Now, Sherwin Williams has fallen quite a bit in the last, so back on December 30th of last year, they hit a high of 354, and they're currently at 238 after hitting a low of 195. All right, so those are just numbers. They don't mean anything without looking at the fundamentals behind them. So if you're new to the channel, I want you to hear that out. The stock price is just a stock price. It doesn't mean anything about valuation, but it's a good starting point to say, oh, okay, things have fallen quite a bit. Maybe there's an opportunity here. But just because something fell in price doesn't make it a good investment. An overvalued company falling 20% is in all likelihood still an overvalued company. So I want you to remember that. So let's continue on by looking at our 8 pillars on Sherwin Williams. Now, here are some things we don't like. First off, 5-year PE and 5-year price to free cash flow, over 30. Now, guys, the reason you'd give these a high PE is 2 reasons. 1, high return on invested capital, which it does have, which means it can invest the money back in the business and get a high return on that, which I love. Or 2, they have a high growth rate along with this high return on invested capital. Now, my guess is Sherwin Williams probably doesn't have a very high growth rate potential, but we'll take a look at that based on our analyst estimates here in just a few minutes. All right, they're buying back shares. Not a huge fan of that based on these 2 metrics right here. You don't want a company buying back expensive shares. Now, I don't know if Sherwin's expensive or not. I have not run the numbers yet to determine that. However, my thought process is when you're selling at these high valuations after falling 30%, these probably weren't the best numbers to be buying back shares. They're taking your money that you have access to as an investor and investing it in themselves at a very poor rate of return. I do not like that.
No, sir, I don't like it.
A little bit more debt doesn't bother me so much for such a big company like Sherwin. But one thing that's interesting to me is revenue growth of $4.2 billion over the last 5 years only saw a $77 million increase in net income and actually saw a decrease in cash flow. So I want to understand why that is. All right, so let's take a look here real quick. Okay, first off, dividend, by the way, 1% pays out about $600 million. Yeah, look at this cash flow drop. They did $2 billion a year for the last 5 years. And last year, they only did $938. So my first thing I'm going to do is go to my cash flow statement and take a look at this. Yeah, there was a big drop. Changes in working capital. Okay, that might be a short-term issue. So let's go and see if they have the growth potential according to analysts. So here's analyst estimates based on our data feed. They're expected to make about almost $9 a share this year and grow to about $15 in the next 4 years, which is pretty decent growth. Low to mid double-digit growth. But revenue growth, boy. I mean, there's nothing here. 22.4 to 24.4, yippee. Not even a 10% increase over the next 4 years. There's no growth there. Okay, that's fine. By the way, I like when I see no growth sometimes because it means people think it's boring and they're going to sell the stock and all of a sudden the stock's going to fall and it might make a lot of sense. So just keep that in mind when you're looking at these stocks. So let's go to our stock analyzer tool. And the big key for this, guys, is use a stock analyzer tool as deciding, should I do more research? There's no reason to go out there and read the 10K and all these things. And, 2 years ago, I was criticized for not buying Tattooed Chef because I didn't understand the company. I didn't read the 10K. And I sat there and said I didn't need to. It was overpriced. Why do any research on something that's automatically overpriced, making my highest of assumptions? So make conservative assumptions, make ridiculous assumptions, and make reasonable ones. And let's see where it lands, all right? Because that's a very, very big thing when it comes to investing. I used to sit there and believe I had to go understand every single part of the company. No. My goal is to weed out crap to start. Now, I might like this and add it to my watch list at a certain price. That way, when it hits that price, I go, let me go do my research now because it's in the ballpark. So let's make some assumptions here. I'm going to go low and go 3, 6, nope, 3, let's do 2, 4, and 6% revenue growth. Profit margin. This is over a 10-year period, by the way. Profit margin seems very consistent. So I'm going to go 8.75, 9, 9.25. Free cash flow margin, 9.5, 10, 10.5. Now, PE, they have a high return on invested capital, but not a lot of growth. So let's go with 13, 14 point. Actually, it's a stable company. I'm just going to go 15 all the way around. I don't really do this very much, but the PE and price of free cash flow, I'm fine with that. And finally, for my desired annual return, this is basically my margin of safety. The bigger my assumptions, I want a bigger margin of safety, which means a higher desired return. Because in order to get a higher return, I need to pay less for the company. So that's where I get my margin of safety. The less you pay for something, the more your return. Just remember that at all times. If there's a future stream of cash flow, the less we pay for it, the better you do, right? So that's the reason why. And you can get 9 or 10% from a long-term ETF. So let's go 12, 13.5, and 15%. Hit the analyze button. All right. So it's currently on my watch list at 120. Doesn't mean I'm buying it at 120. It just means I'll start looking at it and probably selling puts. Low price of 80, 90 bucks, call it. High price of 100 to 115. Middle price of around 100. All right. So the bottom line is it's at 238. It's nowhere close. Why do more research? Because what would it take for me to really believe that number is going to happen? Let's do 10% growth rate on both the middle and high side. It's still not there. And 10% growth rate for the next 10 years is probably not going to happen with Sherwin. So that's why I just say move on, but add it to my watch list. Stock number 2, Nike. Nike reported today. So if you're watching this video, it's probably coming out after Nike reported. So let's take a look at Nike. And I'm going to do this a little bit faster than the Sherwin video because I've already shown you my process and how I'm looking at these companies. So again, Nike is down a lot. A high of 180 basically in November of last year and a low of 82 bucks, and it's currently at 103. Oh, wow, it hit 82. I didn't even realize that. That's awesome. Dividend yield, pretty solid. Eats up about half of their cash flow. High return on invested capital. Let's see. Yeah, high return on invested capital, 20%. But look at these valuation metrics. And again, another example of, I imagine it's working capital, a drop in cash flow, which is probably temporary. But look at this nice growth of net income. Almost $10 billion leads to $33.5 billion. That's a 35% margin right there. And look at their gross margin, 45% with bottom line of around 10 or 12%. So overall, I'm like, okay, this is the kind of company I want. Great brand, going to be around for a long time. I have a hard time believing they're going away. And that's a big key here. All these companies that I want to own for the long run, I ask the 3 questions. Do I think they'll be around for the foreseeable future? If the answer is yes, the next question is, do I think their revenue and profit will increase over the foreseeable future? If the answer to that is yes, my third and final question, can I pay a reasonable price today that factors that growth in where I can get an ample return on my money? The answer most times is no on that one, but it's important to keep that in mind so you can keep watching these stocks. So let's see what analyst estimates are for Nike. EPS growth almost doubling from $3.75 to $7 over the next 5 years. Revenue growth, which is about what? I mean, that's 15, 20% growth. Revenue growth, though, not very high. Not a fast-growing business. That's just it. It's already very, very large. All right. Stock analyzer tool. Let's go. Let's go 2, 5, 8%. Profit margin. I'm just going to do 10 across the board. Free cash flow margin. Well, maybe they can. No, because they're starting to do more direct to consumer. So maybe their margins can get better. Let's go 9.5, 10.5, 11.5. Free cash flow margin, 9, 9.5, and 10. PE. Let's go 15, 16, 17. Because I can justify a higher valuation, I feel, for Nike based on its brand. And let's do the same returns for desired annual return. The stock's currently at 103. Look, I have my watch list of 55, low price of low 30s, high price of 50, middle price of 40. And you might sit there and say, oh my God, there's no way it's going to fall. Well, it was 180, I think, just in the last year. So yeah, 180 to 100. It actually fell from 180 to 80. So for it to go to 55 isn't that big of a deal. Stock number 3, American Express. Now, this is a Buffett favorite. I like it because of its exclusivity. It has a great brand, has great brand awareness. It's for the elite, essentially, and they have a lot of accommodations for people. I like that kind of experience. So let's go check out AXP. Okay, I believe the former CEO of American Express is on the board of Berkshire, I believe. So here's a company that's currently selling for 146, all-time high, February 16th, 2022 of 200. So it's down about 25% from its all-time high. All right, back in 1988, what was it? $6 a share. Look at that. 8 pillars. Okay, now the way they calculate they have their balance sheet, it doesn't make this data enough, which I'm fine with. I'm okay with that right here. My guess is they have a really good, based on how we calculate return on invested capital, that's probably okay. And look, I like the fact that their PE is much higher than their price to free cash flow. I don't know why that is, but I want to understand that. I don't like it when it's the other way around. Buying back shares, okay, fine. I mean, the stock looks cheap in terms of ratios. They have growth in revenue, growth in net income, growth in cash flow. All right, all these things I like. No forward dividend yield. I wonder why that is. Maybe they canceled it. But look at this free cash flow. 5-year average of $10.5 billion. Last year, 15.8. So I want to see why that jumped up so much. So I'm going to the cash flow statement here. Oh, yeah, some big fluctuations here. Changes in working capital were big drops to it. Okay, wow. All right, so you want to take a long-term look at this thing. Now let's go to analyst estimates. EPS growth, not much. 40%, still ample. 40% growth over the next 4 years, which is high single digits, low double digits growth. Revenue growth, not much. 53 to 60, so 30% growth over the next 4 or 5 years. Mid, high single digits, okay. And guess what? With inflation, as costs go up, guess what's going to happen to their revenue? Because every time you swipe, they're going to get a fee. So the more and more, if all of a sudden goods all doubled in cost, what's going to happen to their revenue? It's probably going to double along with it because people are swiping that card. You go buy a pool table for $5,000 and you're swiping your Amex, or you buy a plane ticket, but all the costs double, they're going to get double the fees. It's a good way to hedge inflation, in my opinion. Now, American Express, let's see how they did during a recession. Let's go to the Great Recession and see how their revenue was affected back in the 2000s. All right, it fell. So 24, 25, 22, 23, 26, 29, fell to 24, then started rebuilding again. And let's see how their profit did back then. All right, they still made money, but yeah, it dropped in half. This is an opportunity to use this as an opportunity to buy more shares. All right, so let's go use our analyst. Let's go to our stock analyzer tool and make our assumptions. Now, these assumptions, I think I'm going to go based on just purely cost in the world and inflation. So I'm going to go with 4, 7, and 10%. That's a lot on the high side, but I'm going to stick with it. Profit margin, 13.5, 14.5, 15.5. Free cash flow. Like, look how different this free cash flow is in the last 10 years. It's just been increasing. Is that sustainable? I don't know. But I'm going to be conservative. 22, 25, 28. PE, 15, 16, 17. Price to free cash flow, I mean, it tends to be low. Let's go with 10, 13, 16. And our desired return, I'm going to do 12, 13.5, and 15%. Hit the analyze button. I mean, it's all green here. But what am I doing? I don't know. I'm going to do more research. That's what I'm going to do. I have put sold at it. I have it in my watch list at 125. It takes it right below my lowest price. All right, this is incredible. So guys, I want you to see this if you're new to the channel and just look at this process of which I use on these stocks. Before, when I thought I was buying, when I bought a stock, I was just buying a ticker symbol. It made no sense to me. Now I realize I'm buying a piece of a business. So if I understand the business and I believe in it long-term, as long as I pay a reasonable price, I will make good money. Thanks very much for your time. Don't forget to subscribe. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?